Okay, let's dive into this. Welcome to today's explainer, where we're going to rigorously stress test the valuation of a genuinely fascinating company, Rhythm Pharmaceuticals, trading under the ticker RYTM. Today, we're putting on our equity analyst hats and looking strictly at the raw numbers. We're going to apply standard, by-the-book valuation models to see if the underlying math actually matches the market's wild enthusiasm for this high-growth but deeply unprofitable biotech firm.
And hey, speaking of enthusiasm, just consider this staggering metric for a second. Over the past 3 years, Rhythm Pharmaceuticals has delivered a mind-blowing 453.09% total return. Honestly, if you've been holding this stock, you are probably thrilled right now. But as analysts, this incredible 3-year run-up is the absolute perfect starting point for our financial detective work. We have to ask, what exactly is driving this massive appreciation?
To understand that, we've got to confront the central enigma of this entire explainer. The market has currently assigned Rhythm a massive market capitalization of just over $6.3 billion. Yet, when we look at the actual hard cash generated by the business over the trailing 12 months, we see a deeply negative free cash flow of minus $116.6 million. So the market is literally paying top dollar for a machine that, right now, just burns through cash.
So here is our laboratory stress test roadmap for today. 1. The enigma. 2. Absolute valuation. 3. Relative valuation. 4. Asset valuation. And finally, number 5, the final verdict. Let's get right to work. Section 1. The Rhythm Pharmaceuticals enigma. Stellar growth, massive burn. Now, what's really interesting about this slide is the sheer undeniable contrast. It's incredibly unusual to see underlying financials that look quite like this, alongside a soaring stock price. Look at this. At a stock price of $92.31, investors are buying into a breathtaking 3-year revenue compound annual growth rate of 100.10%, which is paired with an absolutely elite gross profit margin of 89.51%. On a purely top-line and product margin basis, this looks incredible. But then look at the trailing 12-month net income. It's deeply negative at nearly minus $202 million. And the return on invested capital is just devastatingly low at negative 13.45%. So they're growing revenue at a blistering pace, for sure, but they are completely destroying capital in the process. Section 2. Absolute valuation. Missing cash. So, to find the company's intrinsic value based strictly on the actual cash it produces, we're going to start with a discounted cash flow or DCF model. You probably know this is basically the gold standard of absolute valuation. The core idea is simple, right? A company is worth the present value of all the free cash flow it will ever generate in the future. Let's see if this gold standard actually works for RYTM. To build our DCF, we first extract the trailing free cash flow, which we know is negative $116.6 million. Now, because our source documents don't hand us neat forward projections, we have to be completely transparent here and plug in some sensible default assumptions. We're going to assign a standard 10% discount rate, which reflects the inherently high risk of a biotech equity, along with a 2.5% terminal growth rate to simulate long-term average economic growth. Let's walk through the logic really quick. Step 1 is to project out those future cash flows. Step 2 is calculating the terminal value. Step 3 discounts it all back to today at our 10% rate. And Step 4 simply divides it to give us the per-share value. But guys, our model experiences a total immediate breakdown at Step 1, with a historical 0% free cash flow growth rate and a current starting point of negative $116 million. You just cannot mathematically project a positive intrinsic value. The DCF model just completely fractures here. Unless we go in and manually invent massive, highly speculative future cash flows that simply are nowhere to be found in the historical data, the resulting intrinsic value from this model is deeply, deeply negative. The cash just isn't there yet to justify the price tag. Since the DCF is clearly too fragile here, let's pivot over to our second absolute method, the dividend discount model, or DDM. This one values a company based purely on the cash it hands directly back to its shareholders over time. Well, with a 0% dividend growth rate and absolutely zero history of ever paying dividends, which, to be fair, is totally standard for an unprofitable biotech, the DDM gives us the fastest, easiest intrinsic value calculation we'll ever do. $0. Yep, clearly these absolute cash models are really struggling with this stock. Let's try one more. Section: Residual Income Model. Capital Destruction. Okay, if projecting future cash flows is too messy, maybe looking at the balance sheet equity will help our case. The formula logic here starts with the current book value of equity and then adds the present value of future residual income, which is just net income minus an equity charge. But man, the data tells a stark story here too. Rhythm has a return on equity of negative 74.78%. When your cost of equity is hovering around 10% and your return is negative 74%, you are generating a massive residual deficit. This model, too, strongly suggests that capital is just being destroyed right now, leaving us with absolutely no mathematically sound intrinsic value from absolute metrics. Section 3, Relative Valuation, Finding Peers. Okay, so if the absolute cash isn't there, maybe the market is pricing RYTM strictly based on its peers, right? Relative valuation simply asks, what are investors willing to pay for $1 of earnings or sales in similar companies? Now, our source documents don't explicitly list specific competitors, so as analysts, we're going to assume standard high-growth biotech proxies as our benchmark today. Let's break down Rhythm's trailing multiples. Their P/E ratio is negative 29.68. Their EV to EBITDA is negative 31.55. Because earnings are so deeply negative, these traditional bottom-line multiples are utterly useless for us to compare. We are forced to rely entirely on top-line sales multiples, which currently sit at a price to sales of 33.22 and an enterprise value to sales of 31.70. Just let that sink in for a second. Let's actually run the math on that. An EV to sales ratio of 31.7 literally means investors are paying nearly $32 for every single dollar of revenue Rhythm generates. Even for a high-growth biotech, a standard, highly optimistic multiple might sit somewhere around 5 to 10 times sales. If we normalize Rhythm down to that industry default, the implied intrinsic value of the stock absolutely plummets. Relative to its peers, RYTM is severely overvalued unless the market believes they possess some unprecedented monopoly-like pipeline that guarantees total future dominance. Section 4. Asset Valuation, the Floor. Since the growth premiums are just off the charts, let's strip everything away and calculate the net asset value, or NAV. Think of this as the absolute rock-bottom baseline for our equity analysis today. If the company stopped operating tomorrow, paid off all its debts, and completely liquidated, what would actually be left for shareholders? Here is how we logically extract the fair market value right from our source ratios. Step 1, we take the current stock price of $92.31. Step 2, we grab the price-to-book multiple, which sits at 22.97. Step 3, we simply divide the price by that multiple to find the actual book value per share. And just to be completely safe, Step 4 checks the debt load. With a debt-to-equity ratio of just 0.40 and a stellar current ratio of 4.41, their balance sheet is actually quite healthy and highly liquid. They certainly aren't going bankrupt tomorrow. When we run that division, we finally get our net asset value per share, approximately $4.01. I really want to reiterate that this is mathematically derived straight from the data. The tangible, cold, hard balance sheet reality of Rhythm Pharmaceuticals values the equity at roughly $4 a share. Section 5. Synthesis, the final verdict. So, the crucial point is, how on earth do we reconcile a $4 balance sheet with a $92 stock price? Bringing all our disjointed laboratory tests together into a final synthesis reveals some incredibly wide, almost comical discrepancies. The DCF, negative and fragile. The DDM, literally zero. Relative models suggest severe overvaluation. The NAV gives us a highly reliable, mathematically sound floor of exactly $4.01. But admittedly, NAV completely ignores the incredible 100% top-line revenue growth we saw earlier. The current price of $92.31 has absolutely nothing to do with current cash flows or assets. It is a pure, unadulterated bet on future clinical and commercial success. Make no mistake, the market is pricing in absolute perfection. Which really leaves us with this final, provocative thought. When traditional intrinsic value models fail this spectacularly, you have to ask yourself, is Rhythm Pharmaceuticals dangerously overpriced? Or is standard accounting just totally incapable of valuing the massive future potential of a life-saving biotech drug? I'll leave that for you to decide. Thanks so much for joining me on this explainer, and keep questioning the numbers.